vibration that lets success soar high. I will achieve, I will fly high. in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The scheduled commercial banks have been quick in technology adoption, while urban cooperative and regional rural banks have lagged. However, that will soon change as UCBs prepare for a digital push. Business Standard reported that the umbrella organization for urban cooperative banks, National Cooperative Financial and Development Company, NCFDC, will be ready for operations early next year. The new body will enable digital access and help 50 million customers nationwide. NCFDC will also help smaller UCBs access debt markets to monetize part of their balance sheet. Good morning, my name is Ishan Gera and you're watching the Business Standard Banking Show. In today's episode, we'll discuss linking credit cards with UPI and the issue of rupee volatility. We also have an interview with ICICI Prudential Life Insurance CEO and MD, NS Kannan. Our Banking for You section explains what external commercial borrowings are and why borrowers need to hedge their exposure. Our banking expert, Tamal Bandyopadhyay, explains the rupee volatility and the rationale behind the 80 to $1 barrier. But first, here's a look at the developments for the week. Monthly UPI transactions touched the 10 trillion rupee mark in May and stayed above rupee 10 trillion in June as well. But NPCI is ready to give a fillip to these transactions. The digital payments body will soon test the linking of RuPay cards with UPI, enabling more transactions via the platform and moving towards a cardless interface. On Monday, Business Standard reported that NPCI and banks have decided on the contours of the scheme wherein a merchant discount rate of 2% would be levied on credit card transactions via UPI. The scheme would now be presented to RBI. Transactions up to 2,000 rupees via debit cards on UPI do not attract any MDR charges. India's payment landscape may be booming, but the same cannot be said about its Forex reserves. Although RBI had developed a significant war chest, it now seems to be eroding under pressure from a strong dollar. India's Forex reserves dipped further by $7.5 billion as RBI moved in to stabilize the rupee. RBI governor at an event last week said that there is zero tolerance on rupee volatility, while also assuring that most of the overseas debt is hedged and hence there is no need to panic. A Reuters report suggested that RBI can spend $100 billion more to keep the rupee from sliding further down. Meanwhile, the central bank is also working to strengthen the banking framework in the country. A fortnight ago, RBI had put 4 UCBs, 2 from Mumbai, 1 from Karnataka and 1 from Delhi under directions and placed restrictions on lending and deposit-taking businesses. Last week, the central bank announced a 4-tier governance structure for UCBs, accepting the recommendations of the NS Vishwanathan committee from last year. The new system entails classifying UCBs into 4 different groups based on their deposits. UCBs with deposits of up to 100 crore rupees will be part of Tier 1. Those with deposits of more than 100 crore rupees and up to 1000 crore rupees will be part of Tier 2. Those with deposits of over 1000 crores up to 10,000 crore will be classified as Tier 3, while Tier 4 would comprise UCBs with deposits of over 10,000 crore. RBI had also hiked the capital adequacy ratio for UCBs with more than 100 crore rupees worth of deposits from 9% to 12% last week. On the other hand, scheduled commercial banks are ready with another stellar show. Results for the first quarter of this fiscal show that a bounce back in lending and better provisioning has helped most banks tide over the dip in treasury income, which was expected as yields hardened. ICICI Bank's profit rose 50% year-on-year in quarter 1 and NII jumped 21%. HDFC Bank's profits were up 19% and NII was up 15%. The life insurance sector hasn't done too poorly either. More important, with regulatory body IRDAI suggesting more reforms, the industry is expected to boom in the coming years. Business Standard Subrata Panda, in a chat with NS Kannan, ICICI Prudential Life Insurance CEO and MD, discussed the company's financials for the first quarter of this fiscal and the future outlook.
ICICI Prudential Life Insurance reported a net profit of rupees 156 crore in the first quarter of FY23 compared to a loss of 186 crores in the year ago period, aided by significantly lower claims and provisions due to COVID-19. Value of new business increased by 32% to rupees 471 crores in Q1 FY23 compared to rupees 350 crores in the year ago period. Annual premium equivalent of the insurer stood at rupees 1520 crores in the reporting period. VNB margin of IPRU was 31% compared to 28% in FY20. To talk more about the company's Q1 earnings, we have with us Mr. N.S. Kannan, Managing Director and Chief Executive Officer of ICICI Prudential. Welcome to the
Thank you,
Business
Subrata. Thank you for having me on this.
In the past, you have mentioned that you want to double the VNB margin growth. In this quarter, VNB 31.
Past stakeholders is to double our absolute value of VNB of financial year 2019 in 4 years' time. So we have, as you rightly said in your opening remarks, we have grown our VNB during this period by 32%. So given that our target is about 22.5%, we believe that we have made a good beginning towards this journey. So to answer your question, are we confident of achieving what we have set out to achieve? Yes, we are quite confident. The beginning has been good and the levers are in place. So we think we should be able to achieve the doubling of FY19 VNB. The way we view the margins is really as a derivative. We focus on the absolute VNB, and depending on the APE development and the product mix development, whatever turns out as the margin, we take that. And you're right that the VNB margin has also expanded during this period to 31%. At this stage, we do believe that it is sustainable, this kind of VNB margins. But as I said, our primary objective is going to be VNB and margin is going to be the derivative.
Is protection business driving the VNB margin expansion? If so, what is the ideal product mix you're looking at?
Yeah, so if I look at our quarterly numbers by way of product mix, you would observe that two lines of business have done quite well. One is protection has grown at about 22%, because of which the protection mix as a percentage of the Q1 product mix is about 22%. Similarly, if I look at annuity, that has grown at 70% year on year. And annuity has become about 6.5% of our product mix from an APE perspective. So these two, from our perspective, are higher margin businesses. And also the opportunity in terms of underpenetration is quite acute. From underpenetration, it is very acute. From the opportunity perspective, it is enormous in these two segments. And from the margin perspective, the good news is that both these segments have much higher margin compared to the organization's average margin.
What is the ideal product mix you're looking at, sir?
So from the, we don't have a target, Subrato, in terms of this is what the product mix we want to achieve. But directionally, if you look at, to answer your question, just to give a color on that, I believe that the protection has an ability to be between 20 to 25% in the long run. I say that because of the pandemic partly, and because of the general underpenetration, this is a segment which will have a lot of tailwind in terms of demand. And as you know, we have had some challenges in terms of the supply side in not being able to fulfill, just not as a company, just as an industry, I would say, not being able to fulfill the demand in the short period, in the short term, because of the pandemic driven environment. Currently, what has been driving the protection growth for us is more of a credit life and group businesses, not so much on retail businesses. But once things settle down on the retail side, I think retail protection also will be a great opportunity. Between ULIP and the non-linked business, that could depend on the market conditions. Sometimes customer preferences towards guaranteed products. Sometimes they like market-linked products, depending on the market environment. But we are quite indifferent to push either this or that, depending on the customer convenience and customer preferences.
Now, retail protection segment continues to lag while group protection has done really well. What are the reasons for the underperformance of the retail protection business? Is it because of the supply side constraint that we saw during the pandemic?
Yeah, I'll quickly get the group side out of the way. As you rightly mentioned, group has done well. You're absolutely right that what has got somewhat impacted is the retail protection business. I still feel that it is more of supply side constraints, like you are mentioning. Why I say that is because the demand side, we are not seeing any lack of demand. In fact, I would say that the pandemic has made this product from being a push product to a nudge product. In the sense, people want to be insured more. Even if we look at the persistency as a proxy, persistency is improving today post the pandemic situation, because people want to make sure that they're well covered by paying the renewal premiums. So given all those indications, I think demand is quite intact. Supply side constraints have been there. You asked why those supply side constraints. I think it started off with the lockdown, and around that time, we were not able to send the prospective customers for medical examinations. So I think that constraint initially started off in that manner. And then subsequently, companies like us, as well as our own reinsurers, they started tightening the underwriting standards, because when the live pandemic is on, you just wanted to make sure that when you're writing a 40-year, 50-year product, you want to be clear about the underwriting standards. These 2-3 issues led to supply side constraints. I'm not saying now that we are completely out of the supply side constraints. So it's more of a supply side constraint, yes, but slowly it will get better as we are at the tail end of the pandemic, plus some of these processes stabilize on the ground. I think by Q3, we can see a year-on-year growth.
So are you also looking to relax some of the underwriting standards that were tightened during the pandemic?
I don't think wholesale relaxation will happen, but we'll keep looking at the data and see if there are certain types of customers or customer segments where our experience is better based on certain proxies. When we look at, then maybe we can look at it at the margin. Some of these segments we can look at based on, because we do have a large portfolio now, and we do have a little bit of short-term post-COVID experience also. So we could look at it and then tweak it at the margin, I would say. But as you all know, the long-term impact of COVID is still not understood. So I have a feeling that it will take a long time before it gets completely relaxed. But in the interim, we'll be focusing on some tweaking, looking at some desirable customer profiles, relaxing it somewhat. But certain other areas, it may continue as it is. But what has happened, I can tell you, is that the frequent change of processes is behind us, is what I feel. I think it's more of stabilization of the process, but relaxation will take a longer time, is what I would say.
Now, with the interest rate cycle turning and the rate hikes happening, do you think the demand for guaranteed products will suffer, and we will see an increasing demand for non-par products?
Yeah, so the way I look at is that the guaranteed products are chosen by customers at times of uncertainty. So they want some certainty in terms of their savings and the returns from the savings, and that has been the key driver of guaranteed products in the industry. Now, your question is around the interest rate cycle reversal. When the interest rates start going up, some of the other competing products like bank deposits eventually may also see an increase in rates. So now at that time, it is possible that the relative attractiveness of the guaranteed products of the life insurance industry may be somewhat different from what it is currently. So at that time, maybe there is a little bit of demand shift towards the other sectors of the financial services rather than guaranteed products of life insurance. But at the same time, you should also see that at that time, when the overall interest rates goes up, the guaranteed products rates also potentially could go up, because we are able to invest and gain more return. So my sense is that at the margin, it could get impacted. But the good thing about life insurance industry is that we do have other products in the non-linked space as well, like a participating product, which also partly invests in equity. So you may be able to get a better return on a smoothened basis in that product also. So yes, between participating products, non-participating products, and linked products, the demand may shift from one segment to another as the interest rate cycle reverses, as the equity markets become more stable. But that is something we are prepared for, and one has to be careful about the demand shifting from one to another. As long as a company we are prepared to sell all the 3 lines of business, we are quite okay.
In the January quarter, especially, you said that you increased the retention on your books as far as retail protection is concerned, and the limit was increased to around 1 crore. Was it because of the frequent rate hikes that the insurers were taking? And does it not put the company's balance sheet at risk in case there are events like COVID happening again?
Yeah, in the retail protection, Subrata, I'll talk about 2 lines of business. The first line of business is a pure retail term, and the second is the return of premium product, which we introduced in the 4th quarter. And that is broadly about 18% of our protection portfolio today. So in this product, the return of premium, the retention is 4 million rupees. That's 40 lakhs. I just wanted to say that 1 crore, we have not done it because it's early days. The return of premium is recently launched. We thought we should observe the experience before we take up the retention. If you look at the retail term, pure retail term, you're right that we increase the retention to 1 crore. The logic for doing that was that when we looked at certain desired profiles of customers, and we have a long record, and we were one of the pioneers in retail protection, we have a large portfolio. When we looked at that in the desirable segments, the experience, our own actual experience of mortality was such that we would have paid too much if we agreed for reinsurance. So the reinsurer's experience in that portfolio versus our own experience was in favor of retaining more because we had a better risk outcome. And we didn't want to split the profit with the reinsurers in respect of that portfolio. That has been the logic behind this. And largely we look at reinsurance as a capital relief. And when you are at a 204%, 205% solvency ratio, there's no need at this stage to too much optimize the capital needs. So these are the two drivers behind the retention decision. We are continuously monitoring it. To answer your question, it's a little bit too early days because, as you rightly said, we have just done it in a couple of quarters in terms of retention, but we'll keep evaluating it.
What will be the company's target when it comes to VNB margins post FY23?
We will grow the VNB in line with the industry growth of VNB. We have not given any specific target to say we will double it in 4 years or anything like we have done in the past. But we believe that at this stage of the company, now that product mix is well diversified.
Thank you so much for answering our questions, sir. Thank you for joining us on the Business Channel.
Thank you, Subrata. Thanks for this opportunity, and best wishes to you and all your readers. Thanks.
Kannan says the company is confident of achieving a growth of 22.5% in value of new business in this financial year and believes the high VNB margins are sustainable. Meanwhile, whether India's external corporate debt is sustainable or not has been a matter of debate. At a recent event, the RBI governor said that most overseas debt is hedged. But what are these external commercial borrowings and why do borrowers need to hedge their exposure? Our experts explain this in Banking for You.
External commercial borrowings, or ECBs, are loans that Indian companies raise from overseas institutional entities in foreign currencies. ECBs appeal to domestic companies because interest rates in developed economies tend to be much lower than those in India, which makes it cheaper to service such debt. Given that ECBs expose a company to exchange rate risks, hedging the exposure is a method widely used to guard against losses due to swings in values of currencies. Raising of funds through the ECB route rose sharply after the COVID-19 pandemic struck in 2020 as central banks in advanced economies slashed interest rates to near zero levels, making raising funds overseas significantly cheaper. But some companies chose not to hedge their exposure through these ECBs as hedging entails an additional cost. The Indian rupee's relative stability against the US dollar until February 2022 also played a role in companies' decision of not hedging their ECB exposure. Now, with higher interest rates in the US and the rupee's weakening due to large-scale foreign outflows from India, companies that have foreign currency exposure stand to incur a higher cost of servicing or refinancing these loans. Those that have chosen not to hedge such exposure are at greater risk. Moreover, at the time of maturity of these ECBs, the sudden demand for dollars could exert even more pressure on the rupee. According to Reserve Bank of India data, of $179 billion of outstanding ECBs, 44% or $79 billion is unhedged. RBI Governor Shaktikanta Das recently allayed fears surrounding unhedged ECBs by saying that a significant part of the $79 billion was effectively hedged. He said a large part of the debt belonged to state-run companies which have a natural hedge to foreign exposure because of export receivables. Das also said that in the case of PSUs, there was the possibility of the government taking on the foreign currency risk. He pointed out that even the many private firms with ECB exposure had natural hedges in the form of foreign currency earnings.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Another thing that needs an explanation is India's fixation on the 80 rupees to a dollar barrier. Although the rupee breached the mark in day's trade last week, it settled below 80. Our banking expert Tamal Bandyopadhyay explains the rupee volatility and the risks emanating from sharp depreciation. Hi Tamal, thanks for coming on the show again.
Sure.
Now, in your column this week about rupee, you highlight two things. One is the psychological 80 rupee to a dollar barrier, and the second, that rupee is still stronger compared to its REER, or real effective exchange rate calculations. So, is RBI right in managing the value of rupee?
One question, your first one is about the obsession with this round figure 80 years. Even I also wonder what is it? I mean, why not 79 or why not 81 or 82 for that matter? In fact, Dr. Jalan, RBI governor during the East Asian crisis time, he did not believe in any round figure. He used to hit the traders, those who were in the market and creating volatility. He used to hit them hard at odd levels. So that had been the RBI policy at that point of time. So one of the reasons could be, the option contracts are written in that round figure. If it is not in round figure, then it leads to more volatility. So that could be the reason. I really don't know. I don't see any logic behind the obsession. Why not 79? Why not 81? What's the big deal about it? Other part is this, yes, on the real effective exchange rate REER, that's the 36 country trade basket, rupee is overvalued. But does that mean that RBI should not do anything? No, definitely not. Because if you see, RBI never says that it has any number in mind. What RBI is concerned about the volatility in the market. So RBI steps in, whether selling dollar in the spot, and sometime earlier it was also working through the forward markets in the past. But essentially to iron out the volatility. And traditionally rupee, if you look historically, has always been on the higher side based on RER. It's not something for the first time what we see.
You quote a Reuters report about India having the capacity to spend $100 billion more to keep the rupee stable. But doesn't a stronger rupee run the risk of India losing out on its export competitiveness?
No, again, it's not. This Reuters report quotes an unnamed source, so we really don't know who is the source. But if you hear, you must have heard the Reserve Bank of India governor in the recent past at a Bank of Baroda function, he spoke about we need to sell dollar because what's the use of umbrella unless you use it during the rain. But the point I'm making, again repeating, Reserve Bank of India is not spending dollar or want to spend dollar to strengthen rupee. All it wants to do is iron out the volatility, which is not good for us. So I don't think it wants to strengthen the rupee. It again, the very fast depreciation, which is not required, because then what happens is this exporters rush for cover, importers don't bring their money back, and all those kind of things happen. So it all wants a orderly way of moving the rupee, whether it's going beyond 80 also. That's not the. I mean, internally they probably have some figure in mind, but that's not official. But all along, historically, Reserve Bank of India stance is we don't have any particular figure in mind. All we need is to iron out the volatility.
You mentioned in your column about other measures other than selling dollars and what India has resorted to in the past. Now, what can be those measures in the current scenario?
No, historically, if you have seen that we have gone and raised money overseas with SBI as a proxy for the sovereign, and then 2013 during the taper tantrum, we raised FCNRB, which giving a lot of incentives to the banks. And now, of course, now also Reserve Bank of India has taken quite a few measures. For instance, CRR, SLR, etc., being waived for the timing on FCNRB. The cap on ECB have been on the automatic group have been raised. Also, the internationalization or globalization of rupee. You can put invoice on rupee and do trade in rupee. These are the things in works. I think it will take time. RBI will use its resources, which is foreign exchange reserves, judiciously to again stabilize the rupee and ensure an orderly movement. Not any. I would not like to believe that any more measure is required to raise money overseas.
One of the interesting points that I found from your column was your discussion about the India's forex profile, right, which is a closely guarded secret, as you point out. Now, how is India's forex profile is different from other nations, and how is it a problem for India if rupee depreciates more?
What I meant about the profile is actually the composition, meaning how much is in dollar and how much is in other currencies, reserve currencies and all. So which we do not know. Reserve Bank of India does not tell us. And one of the reasons why foreign exchange reserve is being depleted is, of course, rupee's weakness, but also the weakness of other currencies, be it euro, be it pound sterling or Japanese yen vis-a-vis dollar. So when you have those in your basket and when those currencies are also depreciating, then your foreign exchange reserves will deplete. It's not the rupee alone. So that's a composition of it. And profile, if you see that, unlike many other countries, we are a current account deficit country. So it's what the so-called foreign exchange assets, what are they? They are nothing but debt. And if you look at the RBI numbers, it gives out how much is the short-term debt and with residual maturity of 1 year and how much is exactly 1 year debt and so on and so forth. So that way, of course, we are very different from others. We are the fourth largest foreign exchange reserves we have globally above Russia. But that gives us, well, we can be very gung-ho about it, but it's not the reserves that we own. It's primarily debt. That's the difference between India and many other countries.
Let me take you a bit off topic from this week's column. Now, bank profits are zooming again, whatever results have been out. What is the reason behind this, especially as treasury income was supposed to decline this quarter?
Yes, yes, treasury income has taken a hit because of the sudden rise in interest rate. RBI had gone for 2 hikes, 40 and 50, 90 basis point, and that impacted the 10-year bond yield. What is compensating it and actually adding more to the profit is A, credit growth, so the interest income is going up, and B, the depletion in bad assets. In fact, the cost of bad assets, the provision cost or the so-called credit cost, it's coming down. It's pretty low if you look at for the most of the banks in the first quarter. So when your bad assets are not growing, when you don't need to provide for, so the provision was eating away banks' profits in the past many quarters, which stopped actually sometime last year. So once your credit is growing, your interest income is growing, and your bad assets are in control, you are not increasing the bad assets, and you don't need to provide for. You have already sufficient provision coverage ratio. Then that's a good time for banks. And yes, there's a minor hiccup as far as treasury income is concerned. They have been hit, but it's more than compensated by the interest income and the very low.
Thank you. Thanks again for coming on the show. We hope to see you again next week. Thank you.
Thanks.
Pointing to bank results for this quarter, Tamal also highlights that even though treasury income has dipped, credit growth and a fallen need for provisioning have buoyed banks' profit in the first quarter. That's all for this week. We'll be back next Thursday with our next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.